very good afternoon and welcome to HYCM's webinar live market analysis with myself, Giles Cochran, the Chief Currency Analyst here at HYCM. I hope everybody is doing very well for the session. Just looking forward to taking us through and getting ready for the week ahead. Hope everybody is doing well and you can see my screen and hear my voice okay. Please do let me know if there's any questions. Please do type into the chat and the question box as we go along, so I know that you guys can hear and see the screen okay. Okay, well, we have a very interesting start to the week. Just to remind ourselves as we start through that any kind of trading outlooks, entries, exits, etc., are all in the context of education for HYCM's webinar. What that means is that you're looking over the shoulder of someone with a professional trading perspective and you see how you go about making trading decisions. Now, that is not constituting trading advice, so please be aware of that as we go through the session. With that being said, let's get stuck into the main event. Now, the markets have started off this week with a very clear risk off setting. So if we go over and have a look at the markets, we can see that risk off setting playing out. So first of all, let's look at equity markets. We can see that equity markets are moving lower across the board. Looking at them on the 30-minute chart, what we can see is equity markets are pulling lower away from the pivot point towards support. DAX moving lower through the first support level, and the general pressure on the equity markets is lower on the futures markets, and we have the volatility VIX opening and moving higher in the session. So equity markets lower. We're also seeing weakness in commodity markets. We can see copper futures selling off overnight. Silver and gold both pressured on that higher dollar. We also see weakness in the crude complex, and there is also a drop in iron ore. So equities are lower, commodities are lower. Let's take a look at bond yields, and we can see that bond yields are also lower. I'm just going to convert that back to a line chart so it keeps it in sync with what everything else is doing. Now you can see here that the moves in bond yields is moving definitely lower across the board. Now they're marginal moves, but they are still moves lower nonetheless. And when we have yields moving lower, it means bonds are being bought, and that would make sense with the risk-off tones. Downside in equities, downside in commodities. We're seeing upside in bonds, which results in a bond yield fall. So you can just see some yields pressured a little bit towards the downside on the session, but still muted moves. Now, looking at the currency portfolio, we would expect to see weakness in the commodity-based currencies, which indeed we do. Seeing weakness in the Aussie, CAD, New Zealand dollar. And now we're also seeing upside in the safe havens. Yen, Swiss franc, and the US dollar is leading the charge as the strongest currency on the day. So the market has opened in a firm risk-off setting. Now, why is the market in that risk-off setting? Well, there's a couple of things. The most likely explanation is we're just in a little bit of a pullback. Now, the dollar strength we're seeing in the market is the most notable event really going on at the moment. So if we just take a look at the dollar, you can see that the dollar has broken through that ascending trend line and is making its way higher up towards 91. Now, the reason for this dollar strength, there's a couple of reasons. First of all, this dollar strength was precipitated by a spike high in the US 10-year yields. can see here, here's the US 10-year yields plotted across the dollar index, and you can see that this move high in the 10-year yields also lifted the dollar higher. Now, if we just take a look at the 10-year chart itself, which is here, you can see that the US 10-year yields broke out of that 1% region. Now, that was a specific reason that it broke out. The Democratic blue sweep, with the Democrats winning the Senate at the end of last week, really boosted the US 10-year yields. And the expectations now that the Democrats are going to pass a much larger stimulus package. This stimulus package is expected to get the US economy back on its feet more quickly. And so that's why we've seen this move higher in bond yields. Now, when bond yields rise higher, it's because bond traders are expecting rising interest rates. Now, looking at this from a sort of wider perspective, the Federal Reserve has said they're going to allow inflation to run hot before raising interest rates. The Federal Reserve has been quite bearish. So the risk here is if the Federal Reserve suddenly move away from their bearish outlook and start looking more hawkish, then that could precipitate a strong move higher in the US dollar. Now, the Federal Reserve have said they're going to allow the US inflation to go higher, to run hot for a little bit. So one wider term question is, how did the Federal Reserve feel about this 10-year yield breaking out higher? Now, a couple of things for me to say. One, near-term resistance is at 1.25 region. So as long as we're underneath 1.25, I'm not expecting the Federal Reserve to be too worried about it. Above that 1.25, and then we expect potentially, if not to see a response from the Federal Reserve, for people to ask for a response from the Federal Reserve. As prices currently stand, yeah, there's a spike higher in 10-year yields, but it's not it's not outside the realms of credibility. That's point number one. Point number two is, to what extent is the US underpriced going forward? Is the US economy going to do much better than the market's expecting? Because if it is, and if the US economy starts ramping up quicker and maybe does better than expected, better than Europe, unlikely to do better than China, which growth is expected to be around 8%. But if it can beat Europe, then all of a sudden there is strong reasons for US dollar strength. So the bottom line is this: we are seeing some movement higher in the dollar. Now, some of that is just normal part of a pullback, but the reasons for the move higher is those rising US 10-year yields. To what extent that signals a better US recovery at this stage is not yet known. But what we can see here, dollar index breaking higher. Now, this indicates a probable trend change, even a short-term trend. You see, the trend from November to January has been a downtrend. That downtrend has probably changed now with that break high. Now, not definitely, probably. How will we know if it's a trend change? We need step one, break of that trend line, completed. Step two, if we see a pullback to this level, rejected, then that's step two. And step three would be a break of the recent highs. So a break of these highs, or 91 highs, would indicate that there has been a change in the trend. So it's that US dollar story is the main story, and that's being driven by the US 10-year yields rising higher. So that's the key thing to be looking at as we start the week. As a result, because of that US dollar strength, there's a downward bias in the Aussie US dollar, there's a downward bias in the Euro US dollar, and there's a downward bias in the pound US dollar. That's anticipated for all of these, all of these markets because of that dollar weakness. So that should make sense to folks. If you've got any questions, please do pop them in to the question box, and I can help with that as we go through. Now, another thing to point out a little technical tip is just very simply, something that's relevant, just happened recently. Whenever you get a recent high or low that fails, that's significant. So you can see here, we've really got a failure of a recent low. If you look here, that's a recent low in the dollar yen, and then price failed and moved back through that neckline here. So when price moves to that neckline there, that's a failure of those lows. So we are looking at the potential trend change from the June 2020 through to January 21. So a 6-month trend is on the verge of changing. Now, we'll know if it's changed in the dollar yen if it breaks out higher. If it breaks out higher above this trend line, that's a good indication that the trend has changed. Now, this is a trade that I've taken a dollar yen long, and it was based on the weekly chart. You can see here that we had a false break of these recent lows, and that false break of the recent lows would indicate higher prices. So potentially looking for a move higher. First, we want to call up to that 105 level, and if we hit 105, then up to the 106 level. So they're the first 2 targets that I'm looking at. Again, not trading advice, but just explaining why I'm doing that. It's a break of those recent lows, reversal higher. We're seeing a surge in the US 10-year yields. We've got the dollar index also falling into key profit-taking region around that 89 region. Just look on the weekly chart. You can see here, some profit-taking would make sense on a medium-term basis, and it wouldn't be unreasonable to see a sort of pullback in the dollar going forward. So that is, that's really the main issue as we're starting this week. How's the dollar going to progress? So look at the US 10-year yields. You want to be monitoring that carefully. Look at the expectations of the US stimulus package. Biden's been saying that he's going to be doing a trillions of dollars of stimulus for the US, and just keep an eye on that, how that's impacting US stocks. Risk tone at the moment, as we say, is firmly off to the downside. Now, in terms of calendar for the week, it's a very, very quiet week. So just looking ahead, we've got nothing of very much significance. The only event to look out for today, in my book, is Tenreo speaking for the UK. Now, Tenreo may be mentioning on something on negative interest rates, and money markets are pricing in a greater likelihood of the Bank of England cutting interest rates to negative territory in the coming weeks. So Tenreo's comments will be scrutinized on that basis. He is dovish anyway, but markets just trying to get a sense of where the Bank of England are going. So that's one area I'm looking at. The pound is quite interesting this week because of the rising COVID-19 cases in the UK. It's putting significant pressure on UK's infrastructure, particularly the health service here, and any likelihood of negative interest rates that could see some short-term downside in the pound, particularly against the dollar if that dollar strength continues. So that is that's one area to be looking at. Tuesday, we have a very light calendar again. There really is not very much going on at all. Similarly, on Wednesday, we have a light calendar. The only event that's of particular interest, ECB Lagarde speaking, that could give some indication of what the ECB's thinking about. Unlikely, nothing's expected, but definitely one to just flag. And we have CPI data coming out of the US. Now, with the US expected to allow inflation to potentially run higher, that's not necessarily going to be of much interest to the market either. So a pretty quiet day on Wednesday, and even Thursday, again, another quiet day. Fed Chair Powell speaking. Now, the thing to be looking out for from Fed Chair Powell is any mention of these 10-year yields. So on Thursday, he may be asked about this 10-year yields, and that'll be an interesting aspect. If the Federal Reserve sort of say that they're concerned about the rise higher in 10-year yields, they do have the ability to potentially use yield curve control. Now, this is a mechanism by which central banks control this yield curve, and they do it by purchasing bonds at certain levels. Now, the Reserve Bank of Australia, they have targeted a certain level in bonds, so has the Bank of Japan. Now, the US could potentially do that. So if the US said, you know, we're going to keep US 10-year yields in that sort of 110 to 125 region, that would mean they're capping that move higher in bond yields. Remember, when bond yields start rising higher, expectations of interest rates rise. The reason currency traders look at bond yields is to get an indication of what's happening with interest rates in the future. So with these interest rates, if yields keep rising, then interest rates are expected to rise, then that will keep the dollar underpinned. So Thursday could be quite a significant day, potentially, for the dollar picture. So that's just something to keep your eye on, keep aware of. And that's one tool that the Federal Reserve have, is the ability to control the yield curve. So just watch out. Yeah, particularly if this yield goes above 1.25, then particularly watch out for Thursday, because the quicker and the faster this 10-year yield rises, the greater the expectation that the Fed will do something. Now remember, the dollar's rising in line with these US 10-year yields on the basis that if the Democrats have a very large stimulus package, that's going to give a significant boost to the US economy, which means the US economy is going to do better than expected, which means interest rate rises are more likely to come. That's the relationship. So that's what's going on here. And obviously, if the Fed think the market's getting too ahead of itself, they're too optimistic, the Fed's going to want to slow down this strong rise in US 10-year bond yields, and also slow down that rise in the dollar strength. So that's essentially what's going on. That's essentially the big picture, and that's really the big narrative that's going on in the markets. How quickly is the US economy going to recover? And you know, the stimulus package, the response to COVID-19 in the US is all going to be sort of filtered into that big question, and looking at these US 10-year yields moving higher. Again, Fed Chair Powell may say nothing on Thursday as well, so it's not something that's definitely going to happen, but it's something to be aware of for sure. Then we go into the end of the week to what is a very quiet week this week, and we have retail sales out of the US. Now, in itself, it's not a significant data point. As part of the wider picture, it does help a little bit. The US economy is driven by the US consumer. About 70% of US's GDP comes from the consumer. So the market wants to see the US consumer doing well to still play into that narrative, if there is one developing, of a swift recovery in the US. So the thing to look out for is if Fed Chair Powell shows, the other thing, he could show optimism about the US economy, and if the retail sales shows a nice beat on the print, we've got a print expected of 0.0%, but if we get anything in positive territory above the last minus 1.1%, that would be very helpful. That would be a good, anything that's higher above 1 or 2% shows growth territory yet again. So if we do see a strong result for the core retail sales, and we had a sort of more bullish picture from Fed Chair Powell, that could result in some real dollar strength into weekend. So just watch out that you could see this dollar strength accelerating, and the potential would be a bullish Fed via Jerome Powell's speech on Thursday, and a positive retail sales would really underpin some dollar strength for today. In terms of the other events that are coming out on Friday, there's very little of any significance. So it really is very, very light on the data front going into this week, and our eyes start drifting to next week, where we start to get a little bit more action in the week coming. So this week, a little bit quieter. Expect the market to be driven by that risk tone. Watch out for that dollar strength continuing, and watch out for further weakness in the Aussie, Euro, Pound, US dollar. And these markets remain sells at 7,740 for today, but a short-term sell, because we would expect medium-term buys around that 0.7650 region. Do look at the dollar yen. Obviously, a rise and close above that level would open up upside in the dollar yen as well. So that's another currency to be aware of and be on the lookout for a rise above. Stay and break below this low. It means lower prices are likely ahead. Okay, folks, that is all that there is to be said on a pretty quiet week in terms of economic data front. So as I said, it's that dollar story is the key story. So if you're trading the majors, do keep an eye on that. One thing just to be careful, keep an eye on is gold. I will mention gold. Gold has, I was very bullish on gold to start the year. I'm now neutral on gold. Now, this trend line broke higher, and then we've had strong selling from this big supply region. When you have a strong sell-off like this, that tends to make a strong supply level, and it really did. Now, some of the psychology for that is a lot of those sellers that sold here, a lot of those orders remained in the market and haven't been filled. Now, the reason for the strong sell-off in gold was that Democrat blue sweep. So Democrat blue sweep, expectation of a stronger US recovery, strengthening gold. That dollar strength resulted in gold selling. So this is the expectation that the global economy is going to recover more quickly, that the gold as a hedge is not as in demand as it has been. Stay below this trend line and sellers are in control. Get back above and buyers have another bite. But that's just something to be aware of. We found support of that 200 exponential moving average. We found some buyers just coming in at that first test. That makes sense. But that's a key level for buyers, and it's a key level going forward, that 18-17 region. For today, with that dollar strength, we would expect gold sellers. So any retracement back to 1870, 1890, that 1895 region, if we get a retracement back up to there today, we would anticipate finding further sellers. Now, as long as the dollar remains strong, that should keep gold pressured. So in terms of understanding gold and silver, look to the US dollar. Strong dollar, and that weakens the US. Strong dollar weakens gold. If you just take a look at the dollar index, right, you can see here that as as the dollar index, let me just put this on. There we go. Right. The relationship with the dollar and gold is, as the dollar, which is at the gold line, as the dollar falls, gold rises. As the dollar rises, see, gold falls. Falling dollar, rising gold. So rising dollar, falling gold. You can see here a very clear rejection of those higher prices on the weekly chart. So technically, as long as that dollar strength remains, we would expect sellers on any retracements back up to that key level of 1870, 1895, and stops just running above 1920. That trend line should remain a decent area of resistance as long as that dollar strength remains. So stops can be sort of placed fairly confidently for that 1920 region. If stops are taken out on a return here, you know that the uptrend is likely to carry on. It's anyway, at any rate, it's a sort of decent place to define and limit your risk. Okay, folks, that's the main story to get your head around this week. Keep your eye on the dollar. It's likely to drive all the majors and to be the main story of the week, subject to unexpected news being announced. I hope everyone has a really good week, and I look forward to speaking shortly and seeing you on Wednesdays. Don't forget, we have the workshop on Wednesday where we'll look at a dominant currency sentiment for trading. And don't forget, you can ask questions, and it's an interactive workshop. Hope everybody's well. I hope you all have a really good week. Thank you very much for attending, and I hope you all take care now. Thanks now. Goodbye.